The market is currently closed for the weekend, but as of the final bell on Friday, December 19th, 2025, Nebius Group, trading under the ticker symbol NBIS on the Nasdaq, finished at 89.46 USD. This represents a massive intraday surge of 11.37 USD, or 14.56% on the day. While many investors were watching the steady climb of Apple stock or the latest volatility in Tesla stock, Nebius quietly staged one of the most aggressive rebounds in the infrastructure sector. Most people look at a 14% move and assume it is just a relief rally following a week of pressure, but the reality is far more complex. The expectation was that Nebius would struggle with the capital intensity of its recent data center build-outs, especially after the company raised its capital expenditure guidance to $5 billion USD. However, the reality that sparked this Friday rally is a supply-demand imbalance that is essentially making Nebius a gatekeeper for the next generation of compute. While the broader market was distracted by general tech trends, institutional players realized that Nebius is now the first provider in Europe to operate both the NVIDIA GB300 NVL72 and the HGX B300 systems in a production environment. This is not just about having the latest chips, it's about having the power and the interconnectivity to make them useful at scale. If you are looking at the landscape of online investing right now, you see a lot of noise about whether the AI build-out is cooling off. Most investors think the big gains in infrastructure are over and that we're moving into the software phase. That's the common expectation, but the reality is that we're hitting a physical bottleneck that favors specialized players like Nebius. Unlike some larger firms that have to manage legacy cloud systems, Nebius is building from the ground up specifically for intensive AI workloads. This structural advantage is why they were able to secure a staggering $17.4 billion USD agreement with Microsoft. When you see a company with a market cap around $22 billion USD landing a single contract that nearly matches its valuation in total potential revenue, it forces you to rethink the risk profile. The market had been pricing in a lot of execution risk, fearing that the company would spend all this capital on hardware and then struggle to find power or customers. Friday's price action suggests that the uncertainty regarding their ability to monetize that $5 billion in capital expenditure is starting to dissipate. The volume on Friday was also telling, with over 17 million shares changing hands compared to the recent average. This indicates that we're seeing more than just retail traders chasing a trend. We're seeing institutional repositioning. Many people use investment help services or tools like Schwab Intelligent Portfolios to manage their broad exposure. But for an individual brokerage account, a stock like Nebius represents a high-conviction bet on the neo-cloud model. This model is built on the idea that specialized providers can move faster than the hyperscale giants. While Amazon and Google are trying to be everything to everyone, Nebius is focusing entirely on providing the highest performance environment for model training and inference. This focus is why they can offer NVIDIA Blackwell Ultra Compute with 800 gigabits per second InfiniBand interconnect, effectively doubling the throughput for the kind of distributed workloads that companies like Meta and Microsoft are desperate to run. Comparing this to the recent performance of NVIDIA stock is useful because Nebius is essentially the physical manifestation of NVIDIA's product roadmap. When NVIDIA releases a new architecture, Nebius is the first in line to deploy it at scale in Europe and parts of the Middle East. This relationship is why the company is targeting an annualized run rate of $7 to $9 billion USD by the end of 2026. To put that in perspective, they expect to end 2025 with an ARR around $1 billion USD. That's an 8-fold increase in revenue over 12 months. Usually, when a company makes that kind of prediction, the market laughs them off as being too optimistic. But the reality is that Nebius is already sold out of its current capacity. Their growth is not limited by demand, it's strictly limited by how fast they can plug in new racks and secure the power for them. This is a rare situation in any industry where the only thing stopping you from making more revenue is the speed of physical construction. The business model here is essentially infrastructure as a service, but with a heavy emphasis on vertical integration. Nebius designs much of its own hardware and software stack in-house, which allows them to extract better margins than a typical reseller. In their third quarter report, they showed an adjusted EBITDA margin of nearly 19% for their core infrastructure business. For a company in such an aggressive growth phase, seeing positive margins on the unit level is a huge signal for those who invest online. It suggests that once they stop the heavy construction phase and move into steady-state operations, the cash generation could be massive. They are currently navigating a period where their total operating costs are rising because they are hiring 1,300 people and building multiple sites simultaneously across the UK, Israel, and the United States. But the market is starting to look past the temporary losses towards the massive backlog of contracts. I want to hear from you on this because it's a polarizing topic. Comment below with how many shares of Nebius you are currently holding, or if you are waiting for a pullback to the $70 level before starting a position. Do you think the specialized neo-cloud providers will eventually be bought out by the big three cloud giants, or will they stay independent? Taking a step back, let's look at where this company came from because it explains a lot of their technical depth. Nebius is the successor to the international business of Yandex, which was often called the Google of Russia. After a complex divestment and restructuring process, the company emerged as a Dutch-headquartered entity with a clean balance sheet and a massive amount of technical talent. This is not a startup that just decided to buy some GPUs last year. This is a group of engineers who have been building search engines and large-scale distributed systems for 2 decades. That legacy is why they can build a platform like Ether 3.1, which includes sophisticated capacity management and real-time dashboards for GPU availability. Most of the competition is just renting out bare metal, but Nebius is building a full-stack developer environment. When you use a Fidelity trading platform or the Robinhood app to look at your holdings, you have to decide if you want to be in the picks and shovels of the industry or the ones selling the final product. Nebius is the ultimate picks and shovels play. They are the ones building the mines. However, they are doing it with a high level of financial complexity. They recently implemented an at-the-market equity program for up to 25 million shares. This caused some dilution fears earlier in the month, which is part of why the stock was down before this Friday bounce. The expectation was that the company would dump shares on the market and kill the momentum. The reality is that they are being very surgical with how they raise capital, ensuring they have enough liquidity to meet their $5 billion CapEx goal without crushing the share price. They also have over $2.4 billion in cash and equivalents, which gives them a significant runway compared to some of the smaller, distressed players in the space. In the world of online investing, we often talk about self-investing and how to find these hidden opportunities before they become mainstream. Right now, Nebius is still a bit of an if you know stock. It doesn't have the same household name status as something you might find in a typical Fidelity wealth management portfolio, which usually sticks to more established names like Microsoft or Apple stock. But for those using an individual brokerage account or an interactive brokers trading to find alpha, the neo-cloud sector is where the most intense growth is happening. If you look at peers like CoreWeave or IREN, you see similar trends. These companies are all racing to lock up as much power as possible. Nebius recently increased its contracted power target to 2.5 gigawatts by 2026. To put that in perspective, that's enough power to run hundreds of thousands of high-end GPUs simultaneously. The risks are also quite real and should not be ignored. We are talking about a company that is essentially a giant construction project right now. If there are delays in getting Blackwell chips from NVIDIA, or if a local government in a place like Finland or the UK decides to throttle power for data centers, the entire revenue forecast for 2026 could shift. This is why the stock has such a high beta. It moves a lot more than the S&P 500. When the market is in a risk-on mood, it flies. When people are worried about interest rates or a tech slowdown, it gets hit hard. But the Friday move of 14% shows that for now, the appetite for high-performance infrastructure is outweighing the fear of execution delays. The fact that they are already delivering GB300 systems while others are still waiting for H200s is a massive massive competitive advantage. For anyone looking for investment help or trying to understand the broader context, you have to look at the macroeconomic pressure as well. We are in an environment where capital is expensive. Building a $5 billion infrastructure footprint requires a lot of smart financial engineering. Nebius has been using a mix of public offerings and convertible senior notes to fuel this growth. This is a more sophisticated approach than some of the simpler investing sites might explain. It shows that the management team, led by Arkady Volaj, knows how to play the capital markets just as well as they know how to build server clusters. They are leveraging their high growth rate to get relatively favorable terms on their debt, which is crucial for staying ahead of the competition. The future outlook for Nebius centers on two main catalysts for 2026. First is the realization of the Microsoft and Meta revenue. As the capacity for those contracts comes online, we will see the quarterly revenue numbers start to jump by hundreds of millions of dollars. Second is the potential for an acquisition. There has been a lot of talk in the industry about whether the big